Welcome to the very first video blog here on Sensible Investing TV. Well, there's been a lot said in the last couple of weeks about fund management charges. First, the Labour leader Ed Miliband called for a cap on pension fund charges. He accused the industry of ripping investors off. And on the opposite end of the political spectrum, the Daily Mail highlighted evidence that savers are having to spend £12 billion a year in hidden charges. So what's all the fuss about? How much of a difference do charges make to the value of your investments over the long term? Well, I'd like to highlight the research of Tim Hale, a financial blogger and author and CEO of Albion Strategic Consulting in Exeter. Now, you might have heard or read about something called total expense ratio, or TER for short. Now, that's the annual management charge plus the fixed costs which can be offset against performance. Now, typically a fund's TER is around 0.9%. Actually, that excludes around 0.5% in trail commission paid to commission-based advisors and another 0.3% that goes to the fund platforms. But let's just go with that figure of 0.9% for now. As well as TER, you also need to factor in trading or turnover costs, and that includes things like stamp duty, commission, bid-offer spread and price impact. Tim Hale estimates those costs to be around 1% every year. So when you add the average TER to the average trading costs, that makes a total figure of around 1.9% for the average actively managed fund. By way of contrast, the charges on a typical index fund, in other words, one that tracks every stock in a particular index, are just 0.3%. That's a difference of 1.6%. Now, you might think that 1.6% difference is marginal, but when you look at the figures in more detail, you'll see that even a small percentage, or supposedly small percentage, actually makes a huge difference over time. Let me show you. Suppose you have £100,000 to invest and you're in it for the long term, let's say 30 years. You can either invest it in Fund A, a typical actively managed fund, or in Fund B, a low-cost index fund. Now, as I've already explained, the average cost of investing in an active fund is 1.9%. Let's assume an annual return of 5%. In 30 years' time, the fund will be worth £250,000, which doesn't sound too bad. However, if you'd invested in Fund B, the low-cost index fund, and again, the average annual growth rate had been 5%, you would now be sitting on almost £400,000. So the difference in choosing a low-cost as opposed to a high-cost fund is around £150,000. That's no small sum, and it's money you should be allowed to spend on enjoying your retirement, but all too often it ends up in the pocket of your financial advisor and your fund manager. Anyone saving for their retirement should be under no illusion. Small numbers can make a big difference when it comes to investing. That's why this whole debate about fund charges is such a critical one for investors, and why we at Sensible Investing TV will be monitoring it very closely. Follow us on Facebook and on Twitter for the latest developments.